So welcome to everybody on this quarter's webinar. It's likely to be a very hot topic for a lot of people. Investment market fluctuations are all a lot of people are talking about at the moment. So we felt that it was appropriate for this quarter to conduct our webinar on just that. And I'll introduce Matthew in just a moment, Matthew Cady from Brooks Macdonald, who is their investment strategist, and he'll be talking about the causes, impacts and what this means to investors on what's going on at the moment. I'm Debbie Packer. I'm one of the founding financial advisors for Integrity 365. A massive welcome to everybody that's on the call today. I'm delighted to introduce our guest speaker for this webinar, Matthew Cady from Brooks Macdonald. As I mentioned earlier, he's the investment strategist. He sits on the Asset Allocation Committee. He's one of 9 members, so absolutely is perfectly placed to cover this topic this evening. And I'm sure we're more than happy to answer any questions at the end. So as I say, I will sit back, let Matthew go through the presentation, and as I say, any questions that you have throughout the call, if you could just press the questions and answers button, submit a question, submit it through chat, and we'll cover those at the end. So Matthew, thank you so much for joining us this evening, and yeah, absolutely over to you. Thank you very much, Debbie. That's really kind, and thanks everybody for joining this evening. And can I just say, hugely grateful to have the opportunity to have 45 minutes of your very valuable time to sort of share our thoughts and how we see the markets at the moment, and how we're positioning and what our views are going forward. So without further ado, I will share my screen now. Let's see if I can get this working. Right. How does that look for you, Debbie? Does that look okay? Yes, that's coming through clear. Thanks, Matthew. Excellent. Well, so I've got a few slides for this evening's presentation. I'm very aware, I suppose, confessions up front, that investment strategists tend to sort of naturally err on the side of caution and want to have lots and lots of slides, in the hope that they'll have a slide that covers any number of questions that they might conceivably get. I've tried to fight against that sort of inherent sort of urge, because the more slides you have, often it's harder for you, the audience, to really understand what are the key messages. So this evening, I've only got 12.5 worth of slides. We'll dwell on 1 or 2, perhaps a little bit longer. We'll skip over 1 or 2 others, but hopefully it touches on, I think, some of the key themes that I want to try and address. I think what I want to do first off is really, and we'll circle back on these 3 key messages at the end of the half hour this evening, but I really want to try and frame the discussion around 3 key themes that I'd like you to try and take away from this evening's webinar. So the first one, it really is an acknowledgement that we are in a tougher interest rate economic growth outlook. That's a given. Inflation pressures are being more persistent. Central banks are reacting to that with a narrative that interest rates are likely to be higher for longer, and obviously that's having a bearing on the economic growth outlook. So we have to acknowledge that we are in a tougher environment in terms of economic growth, inflation, interest rate mix. That's very much a given. The second bullet point, though, is very much, there's a few nuances here, but it's very much around the idea of acknowledging that we have that tougher economic outlook. It's what are markets pricing in? What are markets assuming right now? I think we have to really remember at all times, markets don't, financial markets don't operate in a vacuum. So they're responding to the economic signals that you and I are reading and hearing about. And so often what's really important is trying to understand what markets are pricing in. And in that sense, the second bullet point here is really thinking about the path of key financial drivers. So I think front and center really is inflation. And clearly we've come through a period of in the last year or so, very elevated rates of inflation, certainly in terms of headline rates, but also core rates as well, when you strip out more volatile components such as energy and food. But it's really the direction of those sort of dynamics going forward. Where is inflation going to track going forward? How quickly does it normalize? These are the questions which are really important for risk assets. And the other theme which is wrapped up to that second bullet point is I guess a really important challenge for asset allocators such as myself. It's the challenge that you are having to position your asset allocation, position your suite of assets for the investment environment that you're heading towards, and not be contemporary in the sense that you become reactive and you try and allocate for the environment that you just left or you're exiting. So you have to look forward. You have to detach is the wrong word, but whilst the economic outlook is there, you have to understand where a market's positioning relative to the economic outlook. The third point really is, I think, a recognition that there is a lot of uncertainty right now. Uncertainty is a given at all times, frankly, when you're talking about investment markets. But I think there is particularly heightened levels of uncertainty at the moment, whether that's geopolitical risk, domestic political risk, that sort of real tension between fiscal and monetary policy decisions as well. But I think the third point really is all about, at the current time, we want to try and neutralize extreme bets between certain investment styles, and so we want to have that balance in equities at the current time, between value and growth, between defensives and cyclicals, for example. So those are the three key messages. Tougher economic backdrop. What are markets implying? What are the direction signals that we're looking for markets from here? And then third point, that need for balance. So those are the three key messages really to dwell on. So let's just get into some of the weeds of the debate. First slide on screen here is very current. It was updated yesterday, and this is the International Monetary Fund, the IMF, and they regularly put out their latest forecasts for global economic growth. Now, I thought it's important to put this chart front and center because, again, it kind of puts into context the economic outlook that we're anticipating at the moment. So on screen here, you've got global real GDP growth. So real in the sense of constant prices. So you're trying to strip out, you're not looking at nominal growth, you're trying to strip out that price dynamic. You're looking at real gross domestic product. And this is looking at annual rates globally since the early 1980s. The black line that you can see running across that chart, that's the average growth rate over the last 40 years, which is between 3.3 and 3.4%. Now, obviously, we're coming off very strong growth rates last year in 21 of around 6%, but this year, and these are the forecast years, which are the lighter blue bars you can see there towards the right hand of the screen. The IMF kept their forecast this year at 3.2% unchanged. They dropped next year's forecast from 2.9% for 2023 to 2.7%. But then it recovers very quickly thereafter to 3.2 again, and then for the forecast years of 24 to 27, you're at 3.3. So the point I'm making here is that we acknowledge that there are pressures in terms of slower economic momentum, and some of this is undoubtedly inevitable when you come out of a pandemic. You see a sort of a post-pandemic global economic restart. You see significantly higher rates of growth initially, and they moderate. The point I'm making is that even though we're seeing the pressures that we're seeing at the moment in terms of inflation pressures, central bank response functions, and what that means for economic growth, the level of pull down next year is not on the same scale that we saw during the pandemic or during the global financial crisis in 2008, 2009, or indeed some other points on that chart. So we are below trend. But are we significantly below trend, and is that expected to persist? And that's really important because, as I'll show later on in the pack, the markets, I think, at the moment have already anticipated a degree of impact in terms of corporate earnings. So the question really is if we do see some economic moderation, is it relatively shallow and short-lived, or is it more sustained? I think that's a really important question to ask. The inflation debate clearly is front and center. This chart on screen here, I think, is quite important because it tries to unpick some of the drivers behind inflation that we've seen. I do think the debate as to whether inflation is transitory or sustained clearly has been very much challenged at times over the last year or so. But I think what's interesting is that despite some of the arguments to say that inflation has been more persistent, there are elements within the inflation basket, if you will, which are definitely rolling over and which are definitely aping a more sort of transitory narrative. So on screen here, we've got US Consumer Price Index, US CPI, and within it, I've picked out two subcomponents of that index. So the red line is durable goods, so think cars, furniture, appliances, household appliances, and so on. And the blue line is services less energy services. And as you can see, when the pandemic hit, that red line went through the roof. That's year-on-year changes, and that I think was understandable, because when you're physically stopping people leaving home and confining them to shopping on the web, and they can't consume services, and they channel all that discretionary spend into goods, that causes bottlenecks, it causes supply constraints, and it pushes up the price of goods. And that's what you've seen. That's now rolling over at some pace. Clearly, the debate is to whether you see that transition of that inflationary burst move into services, which is typically a larger part of the economy. Arguably, it has greater capacity to absorb incremental spend versus goods. But clearly, the debate is does that rate of pickup that we're starting to see on services, does that persist, and does that cause central banks difficulty? But I think what's really important is that for all the conversations around inflation, there are elements which are definitely transitory and other elements which are perhaps being more sustained. And so it's not a one-size-fits-all argument. This screen really just shows how central banks are reacting to the current inflation pressures. What I've got on screen here is, again, focusing on the US market. This is financial markets, so looking at Fed fund futures, and you can back out of that markets' implied judgment as to where they think interest rates in the US will travel over the next couple of years. On the left-hand slide is a snapshot at the end of July. On the right-hand side is the snapshot at the end of September. And the numbers are not necessarily too important. It's really the pattern I want to draw your attention to. So on the left-hand side, markets anticipated a rise in interest rates, but then falling back quite quickly. On the right-hand side, markets have really shifted their narrative. They've adopted that sort of rebuke from the Federal Reserve. And indeed, you've seen that sort of message play out in other central banks globally as well. This idea that interest rates will stay higher for longer, and obviously on the flip side, that causes potential risks to economic growth. This slide, I think, goes to the heart of what I'm trying to argue this evening, which is the idea that we really have to think about forward-looking measures and not be too anchored in terms of backward-looking measures. So when you and I see inflation data, and we've got US inflation data out later this week, for example, that is trailing data, that's historic data. So whether it's the last year or the last month, that's backward-looking inflation data. And that's what you've got on screen here in the green line. That's the year-on-year change in US CPI. The blue line is very much a forward-looking measure, and that's the expected annual inflation rate over the next 10 years, roughly around 2.3% at the moment. And the point I'm making here is that despite very elevated near-term inflationary pressures, what's interesting is that the market has remained pretty anchored in terms of its long-run forward-looking inflation expectation. Now, some of this is a reaction to the fact that central banks have become more hawkish. They've raised interest rates, so naturally that's going to dampen inflation expectations. But I think that really explains all the narrative. And certainly, in the early part of that chart, moving up there in terms of inflation pressures trailing, you still saw pretty anchored views around forward-looking inflation. So again, this suggests to me that we need to be careful about adopting this narrative that we are looking at sustained rates of inflation on a multi-year basis. I still think that we will look back in years to come, and we'll just appreciate how we underestimated the sort of tectonic plate impact of the pandemic in terms of driving those shorter term inflation pressures, supply goods, supply and demand, goods, services, all in the wrong places, bottlenecks and supply constraints, and the pressures that was putting on localized parts of the economy. I've got two slides in this pack which are arguably my favorite slides, and this is one of them. And I think this is a really encouraging slide because it helps to condition how we think about our asset allocation going forward. So what I've got on screen here is reasonably long-term data set. So it's looking at the last 50 years or so, since 1972 through to summer this year, and it's looking at comparing US equity returns against US annual inflation rates. And what this is trying to do is to say, well, what inflation rate are we currently in right now? What's our inflation regime, and what does that mean for equity returns? So over the last 50 and a half years of data, what we did at Brooks Macdonald is that we split the regimes into 4 buckets. So you've got those moments in time when you've had inflation low and rising, inflation high and rising, inflation high and falling, and inflation low and falling. Now, arguably, I think we've been, for the last year or so, we've been in the second column across to the left. That's the shorter column there. And that's where inflation has been over 5% and rising. These percentages, by the way, they represent the percentage of occurrences when total US equity returns were in excess of the annual inflation rate. So this is sort of investor 101, if you will, which is that when you have assets, one of your primary goals is to try at least match inflation. Ultimately, you're trying to beat inflation through your asset allocation mix. So what's really interesting is that clearly we've been in an environment which is very difficult for equity returns to beat annual inflation rates, and that's that second column across. The point I'm wanting to make in this presentation, I think this slide here does it really well, is that if we move to the next column across, your percentage of occurrences when annual equity returns can beat inflation more than doubles from 29% to 63% at the time. And importantly, inflation in that third bucket in from the left is still high, but crucially it's falling. And this is the point I think is really important, is right now I think we're probably in between these two buckets. So we're probably moving out of the inflation over 5% rising, and we're moving towards inflation over 5% and falling. Certainly headline rates have been pulling back from the highs earlier this year. Core inflation rates are still holding around the highs. My personal view is that I think inflation will moderate over time, and given that view, which we can explore in a few other charts later on, I think we are progressing from the second column to the third column. If we are doing that, and clearly there's some debate around that, but if we are doing that, then that suggests that we're moving into a regime, an inflation regime, which is more conducive for equity returns to beat inflation. And so arguably this is the worst time potentially to think about de-risking portfolios, because potentially you're moving out of a very difficult inflation environment into an inflation environment which is more conducive. So what are my arguments as to why I think inflation pressures might be moderating from here? This is one slide. This is looking at supply chain pressures. It's the Richmond Federal Reserve Manufacturing Conditions Survey. It's only a regional survey in the US, it's not a global survey. But what you got on screen here is two subcomponents of that manufacturing conditions survey, which is polled to businesses every month. And this is looking at backlog of orders and vendor lead time. And it's a very simple chart. When you're at 0, it means that you're not seeing any difference month on month. If you're above 0, it means that your backlog of orders have risen month on month. If it's vendor lead times, that means it's risen month on month. And equally, if you're below 0, they've both fallen. What you can see here on the right-hand side, this is a 20-odd year chart, but on the right-hand side, you can see that hump as you moved into the early post-pandemic economic restart, lots of supply chain pressures, but look how quickly that's moderated off. So you are starting to see shorter backlog of orders. You'll also start to see quicker vendor lead times. So it's companies are able to process orders at a much quicker rate. That speaks to me of businesses which are perhaps have that the requisite labour that they need. They're not perhaps scouring the labour marketplace looking for additional hires necessarily, if they're finding that they're able to successfully meet a smaller backlog of orders, but process those at a quicker rate. So that suggests to me that there is an easing in price pressures over the months going forward. Wages obviously is really important, and obviously wages, if they rise on a sustained basis, then that presents a more sustained problem for inflation, because it enables you to maintain higher aggregate levels of spending. This chart, again, looking at US, and this is looking at average hourly earnings. You can see here the vertical columns, those are monthly year-on-year, and you've got the 3-month year-on-year change in red. The point being is that you are below the peaks that we had last year. The data here in August is running around about half some of the peaks that we saw this time last year. So the message here is that while wage growth is still elevated versus pre-pandemic, you're off the highs. And again, it kind of speaks to this narrative that whilst the path to lower rates of wage growth, lower rates of inflation is going to be bumpy, it's not going to be a straight line, we are moderating nonetheless. These next two charts I can skip over reasonably quickly, conscious of time. The participation rate in the US, this looks at the percentage of working age population that's currently either in work or looking for work. Clearly we're below pre-pandemic levels, but as that working age participation rate improves, again, you're going to see greater labour supply to meet that labour demand. And so again, that pushes back on wages. This chart looks at households saving as a percentage of disposable income. You can see how households accrued significant savings during the pandemic. That's encouraged at the time households, perhaps maybe if there were 2 adults in the household working, maybe one decided not to go to work and stay at home. And so that obviously shrinks your labour workforce, with this saving arguably relative to Feb 2020 baselines. Now, you could argue there's greater incentive for households, for workers where they can do, to re-enter the workforce, and again, help alleviate some of those wage pressures. So on to valuations and kind of what this means for markets. I think the first standpoint is this chart here, which looks at global equity valuations. And this is looking at price divided by earnings per share, so your PE ratio using 12-month forward valuations. At the moment, we're sitting at a discount to long-run averages. So the 15.9 times you can see there, that's really your 30-year average. And we're below that. Now, there's an interesting point here, is that we have some cushion in terms of discount to long-run averages. Now, clearly, we can move up to our average valuation one of 2 ways. You can see prices rise, or prices can stay the same and your earnings can fall. So if you have your price divided by earnings and earnings shrinks, then your PE ratio moves up. Working backwards arithmetically, if you assume prices stay fixed at the moment that market prices are correct, if you were to reduce your earnings per share in aggregate by around 12%, you'd lift your multiple up to the long run average. So the way I think about this chart is that markets are potentially already factoring in or cushioning for a 12% reduction in earnings from current levels. Very quickly on bond markets, I think it's really important, obviously, seeing what we've seen over recent weeks in particular. You've seen a really big pickup in sovereign bond yields over the course of this year. It's worth noting that I think we've been relatively well positioned for this rise in bond yields of Brooks Macdonald. Towards the end of 2020 and beginning of 21, we cut our sovereign outlook to negative. We really pared back our exposure of sovereigns in terms of our mix of fixed income down to a very small level indeed. We had the view that yields were probably at a floor and they'd probably rise. That view worked its way through, and then earlier this year we had a big rise up in yields. We actually moved back to neutral. And we raised our sovereign mix. All the time, especially over the last year, we have been skewed towards shorter duration. And the shorter duration, they have much less sensitivity to interest rate rises than long duration fixed income bonds. And so not only have we minimized our exposure within our fixed income mix, but also we've been much more short dated as well, which I think has really enabled us to be somewhat sheltered versus benchmarks in terms of some of the impacts that you've seen this year in terms of fixed income. Bringing those two together, this chart on screen here is one of our signature charts, and it compares earnings yield for equities versus earning yields on bonds. And the blue line is the earnings yield on equities. It's really the inverse of the price earnings ratio. The purple line is really your 10-year bond yield, US on the left, UK on the right. And what's striking is that you still have a significant gap in earnings yield preference for equities versus bonds, which is very marked in the case of the UK, for example. So that informs us that we want to keep that preference for equities versus bonds. Interest of time, I will skip over the next two slides quite quickly that major on the next slide. So earnings growth estimates, and this is really important, despite all the headwinds that we're seeing at the moment, the concerns about economic growth, earnings growth expectations are still pretty constructive. So we're looking at 7% expected earnings per share growth rate 12 months from over the next 12 months on a global basis. That's the black line there. So that's still a constructive level. We've moderated from around 9% earlier this year, but this is not really speaking to the narrative of seeing or anticipating an earnings collapse. You can also look at the most recent quarterly earnings results season out of the US, for example, and there you saw a resounding beat versus expectations. Not only that, but also against 10-year averages, it was also beating as well. So there was, I think, a reasonable degree of resilience, both in terms of earnings and revenues at the corporate level, again, which doesn't really speak to those fears of an impending earnings collapse. I mentioned that there were two slides in my presentation today that I really quite like. This is the second one. Now, it looks quite complicated, but I think it's really quite a simple chart in concept. And what it's trying to say is what are markets pricing in? And remember, this goes back to my 3 bullet points, 3 key messages at the start of the presentation. The idea that, look, we recognize it's a harder economic outlook, but what are markets pricing in, and have markets assumed too much? Now, what I've got on screen here is market prices set against trailing earnings. So this is looking over our shoulder and looking at actual earnings that which have been delivered. Now, share prices are in theory supposed to predict where earnings go. They're supposed to have that predictive quality to them. So the blue line here is the year-on-year change in the MCSI Global Equity Index pushed forward into the future 9 months. So it's again relying on the idea that equities prices are a guide, a lead as to where earnings go. The black line is your year-on-year change, 1 year percentage change in trailing earnings. So what have earnings actually delivered? Now, this chart is not a perfect science. It's not an exact science. No chart is an investment strategy, unhelpfully. But I think we can appreciate that there was a reasonable fit of these two lines here. If you believe the blue line, which is your change in equity prices, is predictive and is suggestive of where earnings go, the black line in theory should catch up where that blue line is on the right-hand side. If that's the case, the black line, which is your trailing earnings, which corresponds to the right-hand vertical axis, is inferring 5 to 10% earnings negative growth. So your trailing earnings is going to fall year on year to the tune of 5 to 10%. So the way I look at this is really, well, you can bring it back to this slide again. So it's, you've got that cushion in terms of potentially already anticipating some earnings moderation. This chart here is suggesting to me that the market, as I said before, it doesn't operate in a vacuum. The market is seeing the more difficult economic outlook, is seeing that tension between monetary and fiscal policy, is seeing that tension between central banks and the higher interest rates and what it might do for economic growth, and is recognizing that there might be a risk to margins, it might be risk to revenues for corporates, might be risk for earnings, but is already anticipating an earnings contraction. So the question we have to ask ourselves as asset allocators is, do we think that the damage for corporates in aggregate is going to be greater than what is already priced into markets? And so that's really the key question. It's acknowledging that markets are already anticipating an impact, a pretty significant impact to the earnings over the next 12 months or so. The question is that enough? Now, clearly, hopefully, the sort of nuance, the cadence from tonight's presentation is hopefully giving you my view, which is that I think at the moment there are some challenges, but we have to keep them in perspective. We're still seeing that resilience at the corporate level. The economic outlook is clearly going to moderate over the next year or so, but it's not going to be as deep as what we've experienced at times over the last 20 years, for example. Equally, if inflation pressures do moderate, that's going to give central banks opportunity to have room to maneuver. You may see short-term rate expectations start to moderate in that environment, and that may also alleviate some of the pressure around those economic fears. And so my view is that I think there's already quite a lot of concern built into equity prices at the current time. Everyone has a different view, and if you have a much more bearish view, then you might have a very different conclusion. But at least this gives you a sense of how we're trying to construct the argument and how we're trying to think and frame the argument. The last slide, conscious of time, Debbie, apology, I know I'm running over by a few minutes, is our barbell. It's the sort of a graphical seesaw, and it's really within the equity context, really highlighting that we have that balance between equity factors. So value cyclical on the left-hand side, growth defensive on the right-hand side, and we obviously pick out regionally where we want to fulfill those style preferences. So really, it does come back to those first three points at the start of this presentation. Look, we acknowledge it's a tougher economic growth outlook for sure. You know, the pressure of interest rates, pressure of inflation, those things weighing on economic growth and what it might mean for the corporate outlook, you know, that is absolutely recognized. But also we have to recognize what our market's assuming at the moment, and also from here, what sort of inflation regime are we moving towards, what's the path of inflation, and how does that potentially set up a very different environment for risk assets, which might be more conducive. And really the third point, acknowledging that, you know, things are elevated right now, things are uncertain, and we want to keep that balance. So I will stop there and see if I should stop sharing screens, and maybe Debbie, we can go to questions.
Oh, thank you so much, Matthew. That was fantastic. I'm always really conscious that being on the investment committee and within Integrity 365 as an advisor, we always get really great updates from yourself and your team, and it's really lovely to be able to share that with clients this evening. So thank you so much. It's a really, really good presentation. Certainly covered the title well. We have had a few questions in, Matthew, so I will just run through a few of these. We may not have time for all of them. Just looking at one of the questions here is around the UK base rate and inflationary expectations, and what your considerations are for those over the next 1, 3 and 5 years.
So really thinking about where interest rates might go, I guess is the question. So, I mean, that's a really interesting point, because you know, clearly central banks are trying to communicate a more restrictive monetary policy setting. The Fed has been very clear about this, but also the intimation has been clear from other central banks as well, that you need to push beyond what's considered a neutral rate. Now, just to back up a little bit, a neutral rate of interest is the interest which basically helps accommodate in the case of the US, it helps accommodate full employment and stable prices. So you're not sort of seeing deflationary or inflationary impulses become sustained, and so it's that equilibrium interest rate that you could hope to see. Now, what's interesting is that the Federal Reserve, for example, their perception of neutral rate right now is 2.5%. A decade ago, it was close to 4%. So that in itself isn't a fixed point. That it's not like a rock that you can anchor against. That also is moving around. What's clear is that central banks believe that they have to move beyond what's considered a neutral rate, wherever that rate is, and move into genuine restricted territory. My concern, and it's a bit like sort of the psychologist of Abraham Maslow, sort of Maslow's hammer. You know, so if you only have a hammer, everything in the world looks like a nail. And so this idea that, you know, they have a very big hammer with interest rates, and they think they can resolve all the ills of the economy through raising interest rates. My concern is that I think there is risks of a policy misstep here, because interest rates work really well when you're trying to correct excess demand. They don't do anything for correcting deficits of supply. And if you look at real GDP growth rate levels, the UK is not even back to where it was pre-pandemic, and the US is only 2 or 3% above that, or about 3% above that. The EU is somewhere in between. The key message really is you haven't seen genuine, the way I see it, you haven't seen genuine economic overheating. It's really been much more about supply constraints, whether that's constraints around energy, constraints around supply chains, and that, or constraints around labour, for example, because I think that's what's driving some of the wage hikes that we've seen in the last year, is really a labour constraint rather than net additional labour demand. So, you know, to answer the question, where do I see interest rates going? I think interest rates clearly will, in the near term, be restrictive. They'll be above natural rates, but my view is that I think that will moderate quite quickly. I think that some of the implied expectations around interest rates into next year, so the markets are implying UK interest rates, for example, to be not far off 6% over the course of next year, which I think is very high. My personal view is that I think we won't reach those levels, and I think you'll start to see those inflation pressures moderate, and that will allow, you know, central banks to have that room for manoeuvre, and you'll see some easing in terms of short-term expectations. And incidentally, that I think will also have a bearing on how we are positioned in terms of our fixed interest exposures. So as I said before, we're focused on the shorter end of the curve, where yields have moved up quite quickly. So, you know, UK 2-year yields, you know, around 4%, which is a huge number. And I think what's really interesting is that as you see that moderation come in from lower inflation rates, I think you'll see that front end of the curve drop down quite quickly. And if we're positioned as we are there, I think that gives us opportunity to capture that. So the short answer is I think you'll see rates move up into restricted territory, but I think they'll come back down. I don't personally buy into the argument that they're going to be at a high level and sustained for some years. I think we'll see that moderation.
That's really interesting, because I know a lot of conversations that clients are having, and a few questions that have come in this evening as well, are around sort of that interest rate dilemma, if you like, because you know, you've got borrowers as well with mortgages, and it's what happens when fixed rates end, but you've also got then that savers dilemma, you know, in terms of, you know, do they put more money into a portfolio at the moment, because at the moment there's a dynamic that interest rates are going up, but for the last, well, for so far this year to date, their portfolios are becoming down. So what impact would that sort of significant increase in interest rates have on an investor's portfolio, Matthew?
Well, I mean, so interest rates, so when interest rates rise, it tends to compress your price earnings multiple typically. So we've looked at studies where over the last 50 or so years, when you've had inflation at sort of between 1% and 2%, that tends to be much more conducive to seeing higher price earnings ratios versus higher inflation rates. And the logic behind that is quite sensible, which is to say, ultimately, high inflation rates, higher interest usually is accompanied by higher interest rates. An interest rate is basically a discount rate. So when you have a company that's making earnings over the future, especially growth companies, where the weight of their earnings profile is into the future, when you're discounting that back to net present value terms, at a higher discount rate, it's worth less in present value terms than if you had a lower discount rate. And so I think when you have high interest rates, that naturally compresses the multiples that people will ascribe to equities as an asset class. I think for fixed interest, for bonds, again, I think it basically, you know, high interest rates is a headwind for fixed interest. And I think, you know, we've recognized that risk over the last year or so by having that shorter duration exposure, because obviously the longer duration means you get much more impacted by changes in terms of interest rates. I think what's also interesting in terms of fixed interest is how that shape of the curve might develop. So my personal view is that I think, you know, to carry the narrative on before, if we see that moderation in near-term inflation pressures, and that provides central banks that room for manoeuvre, potentially not only does it bring the short end yields lower, but also it enables longer end yields to remain constructive, because obviously longer end yields would drop if markets became fearful of an economic recession being more pronounced or more pervasive. And clearly, if you see that pressure alleviate around inflation, alleviate around interest rates, markets will be more reassured that economic growth is going to be more secured longer term. And so you see a natural upward sloping yield curve sort of reassert itself. And so you might not actually see significant yield movement at the longer end of the curve, but you would do at the short end of the curve. So again, that's conditioning how we're exposing. So I think, what's interesting this year, and as a bit of a segue to thinking about the valuation multiples, is that over the course of this year, in aggregate, obviously you have company sort of idiosyncratic examples, but in aggregate, over the course of this year, earnings have actually held up. And what's really been impacting share prices has been the compression of the price earnings multiple, the valuation multiple that you ascribe to those earnings. Going forward, I think there is an expectation that you'll see that multiple expand, and we had our asset allocation committee meeting earlier today for the month of October, and we conducted an internal survey amongst our committee members as to how they see certain asset classes progressing over the next 12 months. And one of the key findings was that we don't really see a material change either up or down in terms of the earnings profile. So importantly, we're not looking for an earnings deterioration, but we are anticipating an expansion in the valuation multiple that's ascribed to those earnings. And I think that also ties in with the idea of inflation pressures ease, interest rate pressures start to ease. That lifts that pressure, that downward pressure on multiples, as you can see at multiple expansion. So I think going forward, markets potentially will recover through a multiple expansion rather than a earnings expansion, because you haven't seen that earnings impact.
Yeah, no, absolutely. No, I think that's a great answer, Matthew. Thank you. And I guess so asset classes are going to sort of recover at different times as well, aren't they? So some will be more sensitive, and again the global assets. So just very finally, I think we are very, very short on time now, so I'm really sorry. But that final question, we've got lots, and we'll get them all to you so that you can respond, obviously, and we'll get that out to everybody else that's asked a question. But finally, just in terms of sort of asset classes and the movement, which asset classes do you see recovering first against the backdrop of what we're looking at the moment?
I mean, that's a really interesting question, because obviously year to date you've seen a sort of a synchronization, haven't you, in terms of asset classes being impacted. Higher interest rates has obviously weighed against bond exposures as well as equity exposures, and so I think it's quite hard to. I think what's really important is that you need to have a balance of asset classes, and that's what we've tried to do. We've recognised that with higher yields, bonds can play a more important role in asset allocation diversification. We've got our equity exposures and our preferred skews across regional exposures. We also have exposures to structured return investments. We also have exposures to alternatives and to uncorrelated assets. So it's really, rather than trying to put all your eggs in one particular asset basket, it's trying to get a spread of asset classes. But yeah, it's a really difficult question as to which one of those asset classes is going to necessarily lead. I think it's quite hard. That
diversification, which
absolutely
with clients is really important. Thank you so much, Matthew. Sorry, we have got more questions, but unfortunately we're out of time. But we'll get those other questions to you. Hopefully that's been really insightful for everybody who's been able to join this evening. We will send out that recording, and we'll get the other questions across to you. But yeah, from myself and Matthew, thank you so much for joining us this evening. Thank you to all the people that have attended. Hope you found it interesting, and by all means, if there are any more questions that you have, please do drop us a line, email us, however you want to communicate, give us a call, and get in touch with your advisors for any more questions. But from myself and Matthew, thank you so much for joining, and look forward to speaking again soon.
Thank you.